Capital raising superclass. We are going to go over a very simple but effective methodology that you can use to raise venture capital. Now, the prerequisite to this is that you have an excellent company, because only 1% of companies end up being venture fundable or getting venture financing. I'll make some different videos on what are the components of a venture fundable company. But in this video, we're just going to go over a super class that will leapfrog, quantum leap, shortcut your understanding of how to effectively raise venture capital. Now, we're going to keep this video as well focused on the ideas and the concepts and the paths and the thinking processes. And then in another video, we'll go over the actual action steps, the details, and all of those things. So when it comes to raising venture capital, let's say you met the prerequisite, you have a venture fundable company. The next step is your methodology by which to raise money. Now, if you are, let's say, a venture fundable company and you're anywhere between pre-seed and Series A, chances are, or at Series A, chances are venture capitalists are going to be your target investor group. That doesn't mean that you can't raise from angels or family offices. We are just going to focus specifically on venture capitalists because, in fact, you'll find that they are the easiest to ultimately raise money from if you have a very good company. Angels and others of that nature are actually harder to get in contact with and to have good meetings with. So that is something that you will actually save you tremendous amounts of time. The reason why is that venture capitalists, they're out there in the world and they say, this is what I invest in, this is what I do. You know where they fit in terms of the sector, stage, check size, how they like to provide value. And so that's the other thing about raising money from venture capitalists, is that many of them are going to provide enormous value on top of just capital. So that is where we're going to focus. So the methodology, to go back to that, is you should be thinking about, how can I get in contact with them, or who do I already know? So let's focus on the who do you already know first. If you have relationships with other founders who have gotten venture financing, great to talk to them and see if their investors are complementary to your current company. Or if you have employees, partners, or people that you know who can introduce you to those venture capitalists that they have good relationships with that also match what your company is, that's going to be extremely beneficial to you. But let's say you have nobody and you actually have no money. We're going to go from that perspective. If you have nobody who can give you introductions and you have no money to invest, well, the best thing that you can do is think about outreach methods, because there's really inbound and there's outbound. So if you're going to develop inbound, you could do that. This would be things like content. It would be things like writing articles that are relevant to your business. But the chances of you attracting an investor with that, within a reasonable time frame, are quite low. You can use that information to augment your outreach efforts, right? They work together synergistically. But if you're just trying to say, hey, I'm going to make content and I hope investors engage with it, you better have a very good strategy about how they're going to receive it, what the next steps are, and how they get into your world. But if you're okay with a very long-term approach, that's absolutely a good way to go. In fact, that's why I'm making these videos here, so that this reaches the right people. So we build an audience over time and can provide enormous value to them. And when it comes time, say I'm raising capital for my own company or another company, there is an opportunity there. So with that, where does that leave you? Well, it leaves you with outreach. Now, let's talk about the methods within outreach. So you have LinkedIn, you have email, you have phone calls if you can get those numbers. And that's really the extent of most outreach or other social media channels. So the first thing I would be looking to do, if you're in that zero money position and you want to go raise capital, then what you're going to do is go onto LinkedIn and start to identify who you want to raise money from. And that is going to be things that are going to be a look inward. What I mean by that is, where is your company at in its life cycle? Where are you trying to go? What is your sector, your stage? What check sizes do you need to raise money at? Are you looking for someone who can do 500,000 or a million or 10 million or 50 million? Where is your company at? And that's going to inform your next step search. Then after that, there is a web within LinkedIn or a web with an email. By the way, I'd recommend that you look up, there are plenty of these tools. So I won't name anyone specifically, but there are plenty of tools that you can use which operate directly on top of LinkedIn that will allow you to pull an email as soon as you find their profile. So you can go on their profile, it will pull their database, or it'll scrape the profile or whatever magic it does in the background, but it'll give you that email, because your goal then, if you're going to do outreach, is to maximize the number of outreaches that you can do and that are effective. So that is, you can do connection request messages or just connection requests and build that network, build that audience of potential investors. The next is you can do in-mails. If you do have Sales Navigator, you can do that. And the next is the email. So once you have those foundations in place, then it's just about continuing to do the actions consistently or having somebody else do the actions for you. So, and I would, if you're newer to this, I would absolutely recommend that you do it yourself for a while and you see what works. But just to shortcut it, what you can do is you want to be thinking about how your business is 10x different from everybody else, or what is that value that is irreplaceable to your customers, or what is truly unique about your company. Maybe you have a pretty good product in a big market and you have a insane distribution strategy that you're working on. That also, it works. It's how do you build up the energy to pass the threshold of which somebody is excited to engage with your company and they can realistically see how that company could significantly increase in value. So for example, with venture capitalists, they're thinking about how can they find 100x opportunity that will offset all of their losses in their portfolio. That is the mindset that you want to get in, because that's what they can invest in based off of their LPA, their limited partner agreement. So suggestion at that point, go and do some outreaches your own and see how you can craft your message, because I'm telling you, your message will change over time. And that really just comes from repetition, seeing what investors engage with, and the continuous thought about it is one of the best exercises that you can do for your company, because next time you go into a sale, let's say of a client, you're going to be thinking about that exact same material, that compelling pitch, that compelling narrative, the compelling story that you were giving to that investor is going to go benefit you in your next sale as well. So this is where the process is pretty unglamorous, but it is effective. And that is simply reaching out, getting a message out across to them that is compelling about your company, letting them know where you're at, and simple call to action. Are you interested in learning more? So that simple call to action, are you interested in learning more, is 2 times better at converting than most other messages. The reason why is that you're just selling the conversation. They're just wanting to take the next step. You're not trying to get them to change the game and throw money at you already. You just want them to move forward and take the next step with you. And that is how this works. It's like the NFL. It's like football. You get, like, let's say running in the NFL. They know that it's possible you could, the running back could find a hole and go 80 yards and bust a touchdown. But the most likely outcome is anywhere between 4 and 5 yards. If it's a strong running team and they have a good offensive line and a good running back, 4 or 5 yards a carry, and they keep the ball and they keep moving it forward, then they can do a short pass because now the run game has opened up. You see, football is a great metaphor for this because it's very, very true. It's all about very, very true to outreach, where you're just trying to move the ball forward and get to that next step. You can throw a touchdown pass. Believe me, you absolutely can, and throw and hit a touchdown pass. But the chances are is you got to get comfortable with 6, 7, 8, 9, 10 outreaches until you get a message. And that's just the fact of it. And it can be some interspersed balance in there. So what it is, just to use our football metaphor. So here's the interspersed balance. You send out the initial message, they're interested, and then that's your 5-yard run. The next thing is they say, hey, sounds great, I'll get back to you in a few days. And all of a sudden, now you're waiting. And now where's the onus? The onus, when they say that, is really on you to follow up. So that's all right, we have to take the next play and the next play. And then they're going to follow up. They're going to say, yes, we're interested. And all of a sudden you're trying to go back and forth about scheduling. And that is the mindset you want to be in. And here's the number one tip that I have for this stage. You can do very low level messages out that are just, hey, just seeing if you saw this, want to move this forward. If that works, simplicity is better in that case. You don't need to overcomplicate it. But the best thing you can do is have your offer be really exciting, whatever you're pitching to your investors. So for example, if you had, we followed that train of thought, they're now sitting there and they're waiting to schedule or trying to see when their calendar clears up or whatever, anything like that. Maybe they're traveling, right? That's a common thing you get. Then what you want to be doing is working diligently to not only keep your outreach and that investor funnel full, but on top of that, making your company more interesting. So for example, go close a deal, go move a partnership forward, go hire a new team member, and then let them know that and say, hey, we are moving this forward. Just show them, not even really saying it, you're just showing them. And then you will tell them and say, hey, we're moving this forward. We're getting this investor's interested. We just got a lead investor. This is moving fast. And that is real. And it's true to you and true to something that you control. That's the beauty of it. Realize that you control this entire process, because simple enough, if you have a phenomenal company, you're persistent, you take the actions, and you continuously move forward, you are going to be a investable person. And that is the most important thing, is, are you an investable person? So that is where we get to. You schedule a call, you're ready to do a pitch. So your pitch, you have, again, think about your offer, whatever it is, having up to 15 different pitch formats. And you can break that down. It's one line, your short introduction. Hi, I'm Jacob, and this is what I do. Here's my company. This is what we do, who we serve. Then you have your elevator pitch, and you have your paragraph pitch. And that actually goes all the way down up into a real TED Talk presentation. And I'll share a resource on that at some point when I can figure out how to get it best to you all. But what that does, if you go through that entire process, then what that's going to do is that you become accurate and deadly communicating your business from any angle that you're approached from or that you're communicating from. And it really just becomes that pattern in your mind. So that's where you want to be in terms of the pitch. You just want to have it so patterned in your mind. And the key trait that separates somebody who can raise capital versus a founder who is extremely good is really just that energy. It's the excitement. It's the enthusiasm. It's the fact that when you are really, really excited and convicted about something, other people pick up on that energy. For example, there's one founder that I work with that if you spend an hour with him, we look to get investors on the call for an hour, because if you spend an hour with him, you're going to invest in his company. And that's simply because he's just so freaking excited about it. And that's where you want to be. There's the excitement, but then there's also the balance of what I would call, it is a balance. There's excitement, there's a balance of realism, and there's a balance of short answers. So for example, if you're asked a question and it's a straightforward question, try to give as quick and a direct answer as you can, because it just shows that you're more prepared and that you know more about what you're doing. Then on top of that, you will have the opportunity, and I think it's really great for you to express yourself about, hey, you're going over your opportunity slide and you just love this part about the product and what the customer value is and why that's a key differentiator and why that creates a technical moat and those sort of things. You see how that could just keep going. The investors are going to pick up on that as well. So the pitch, I recommend using the pitch formats plan. I'll give it to you, that I use personally, because again, that's going to help you get dangerous about what you're doing. Now, next, you've given the pitch. What about your ask? Well, your ask, it's great to just be direct about it and go ahead and lay it out there. Say, hey, here's what you get to that slide, say it's your 15th slide in your deck, and you just stop there and you pause after you are done. Then let the investor come and ask questions. Once they're asking questions, then you're back in that opportunity to shine. And never hesitate to answer a question with a question so you can get more clarification, so you can be more specific, so you can, give them exactly what they're looking for. Because sometimes you get the questions where it's a general, broad question And the best thing you can do is get clarification before you answer, because it's just going to come across as you're more aware about, that specific area or sector. The next thing is, if you don't know something, that's totally all right. Just be very clear, like, hey, we're still working this out. That's if you're at the early stages, definitely. Hey, we're still working this out, or that's something we're running tests on, or we are gathering data on that right now. Then, it keeps the conversation open, and you don't always need to have an answer for everything. So this is a key tip. So when you are pitching and you're sitting there, you've already done your ask and they're asking questions. Pro tip is to go back and forth. So let's say they ask about your go-to-market, go back to your go-to-market slide, because then you're hitting it visually and you're hitting it auditorily. And then, through your energy, you're also getting that kinesthetic feel. So you're resonating in various layers of their brain. And that way that information is going in better. It makes more sense to them. They're able to connect the dots. So for example, as you're talking about your outreach methods for your go-to-market, well, they can see exactly what outreach methods you're using, maybe the math that's behind them, who's driving them, that sort of thing. So that is a pro tip. And then whenever they're done with that, so they might ask 3 questions on go-to-market, then go back to your ask slide, because it resets and it sets back in their mind, I'm here to raise money. Here's what we're focused on. And this has been remarkably effective for me and for others. It's really that simple. And the more you can internalize the way these processes work, the easier it's going to be and the more confident you're going to be. So just to give you some insight, let's go over the call in total, that typical first pitch call in total, how it works. And I'll just go over it again in an overview perspective. You come in, you have light introductions, you ask them to share more about their firm, which they're going to give you the details, ask clarifying questions. So for example, if they didn't mention their check size or their timelines, ask that, and then get right on into your pitch. Ask for permission, say, hey, sounds awesome. Seems like we're in alignment. I would love to share our pitch if we can go ahead and get started. And they're going to say yes. You go into your pitch. You do exactly what I just told you. You stop at the ask slide. You go back and forth from whatever they're asking questions about back to the ask slide. If you don't know something, that's okay. Let them know, and keep it really open, light-hearted, and good-spirited, because that energy will be reciprocated. It's 100%. I've seen it many, many times. So with that, I guess one other tip about the call is that if there are times, because there are investors who will want to come across as a little bit harder to play, a little bit harder to read. One of my clients calls it holding the cards close to the chest. You're going to run into those investors. The thing is, most times, more often than not, they're actually really good people, and they're just doing that because that's their methodology to make sure that they make the right decision. So all we are trying to do in this specific case, just like to go back to the football example, we just want to get the first down here. We just want to use our 4 downs, which are, that each step in that process I just laid out for the call, to get over and get the first down and get them to want to move forward. So be aware for that. So you might get hard-angled questions. You might get them very lean back and short and cut. But those people typically are the ones who make the quickest and smoothest and best decisions, because they're not getting too emotional into the process, but they just make decisions based off of where their criteria is. So that is very valuable for you to know. So we did the pitch. Now, you've got your outreach system continuously turning. You're hitting a certain number of outreaches every day. Maybe you brought in another person to start to get more of those messages out. I would say bring your inboxes together if you can. Use an inbox aggregator. Again, there's a lot of those out there. I'm not going to name any specific one, but you bring those inboxes together so you can continuously see. That way you can jump in at any point and continuously move that pipeline forward. You've gotten on some pitch calls. Let's actually go over the pitch deck. So the pitch deck itself is, we'll use a general structure, but realize, it is what you desire it to be. Like, how do you really want to pitch your company? There's a lot of different ways to pitch different things, right? There's so much nuance. But let's just say we're going to focus on your typical product offering. So intro slide, not necessary, but you can use it. I like to put the team slide second. That's just my preference. The reason why is that there's a saying that, well, if your team's really strong, you should put your team slide first. I believe if you're a venture fundable company, you probably have a very good team, and that you should just sell your team of who you are. And no matter what those facts are, like, hey, this is who I am. This is who my co-founders are. We've done this. And there's exciting things that each of you have done. That's why you're a venture fundable company. again, I like to start with that slide because it shows that, hey, this is we're the people who are going to bring this forward. You're investing really in me. Even, maybe later stages, it's not as important. Let's say Series B or what have you, because you have now 20 people on your team, or 10, 15, 20 people, and you're growing and you expect to hire a lot more people, and the work is really disseminated between many people. You can see where the team slide might be less important, but it's good for you to give an introduction about yourself as well, fitting in that call structure that I laid out. Next, after that, go straight into the problem. Really dive deep into the problem. This is where you should probably spend most of your time in terms of your pitch, but we're still talking only a few minutes, and we'll talk about why that's important in a minute. Then from there, get into the solution, get into the market, get into your competitors, get into your business model. That one slide I want to touch on further. So your business model, you want to have lifetime value, your customer acquisition cost, or your estimated, your close estimations of these numbers, your unit economics, that right there, and your gross margin. That right there is proven to get companies funded at a significantly higher rate. And also then they raise about 2 to 3x more follow-on funding in future rounds. That actually connects to a different video that I made about billion-dollar companies. It might have seemed like a very simple video, but in fact, here's what we sell, here's how much money we make, here's how much it costs, here's our profit margin, here's how we can scale it. That right there, that simple level of thinking is missing from so many founders that I've worked with in the past and companies that I've seen. It's so important, that information right there. So now, then from there, after we do have our business model slide, let's get into the technical element of your product. Let's say, again, it's a product. What's your technical architecture? People want to see that. They're going to ask for it anyways. So have it in there. And why is it different? Why does this create a benefit for the customer? And then a little bit, if you can, about the customer experience if your product is live. That way they just go together seamlessly, hand in hand, your technical architecture and the product itself. Then from there, you're getting more right into that ask territory. We pretty much covered everything. You could throw your ask slide there. And then after that, then you have supporting slides. So I like to cut my pitch decks in half, essentially, where your first 10 slides are your pitch. And then you have maybe it's another 5 slides, which augment during this question asking phase. Let's say they ask, well, so what's your use of funds? Because you don't have it on your ask slide. You just have a very simple, straightforward ask slide. Maybe it has, here's what we are, here's how much money we're raising, here's the valuation, here's our current investors. Then they're going to say, well, what's your use of funds? Go to slide 14 that has your use of funds. I like doing it in that format because you like to keep the information as simple as possible. Why? Because you'd be really surprised. So there is one software I will name that I use, and that's pitch.com, top of your pitch deck. So for example, you have your pitch deck and you can create individualized links and then send that out. So you can make it for Jim, Johnny, Jenny, all those people. And then you can actually see, how did Jim, Johnny, and Jenny engage with the pitch deck? What slides do they look at? How long did they look at them? And you'd be really surprised at how quickly people are looking at pitch decks. So the point of that is that you want to make every slide not only simple and to that point from a visual standpoint, but then also from an auditory standpoint, and then just an experience standpoint, because your pitch is your pitch. Again, 5-7 minutes. It can go longer. There's nothing wrong with that. In fact, there's a founder that I know that does extremely long pitches and it's the same one, is crazy excited about what he does. And that is, there is value to that, but it just depends, where you're at. And that's your founder's awareness that you can use. Are you focused more on a short pitch? Do you have something clear, concise, and compelling? Or is your market a hard market? Maybe you're in deep tech, which is where he is, and you're in deep tech and you're explaining this niche customer value that is game changing and nobody knows about, and you have to go into it. Or you're in a unique emerging market that people don't know about and you're doing market education. That's really where you're going to decide, is my pitch short or is my pitch long? So with that, we have now covered the pitch deck, and let's go through it. We've covered the outreach. We've covered the messaging processes, the follow-up. One key point as we're on that I'll note about follow-up. So when you do your initial outreaches, like I said, chances are you're going to have to do numerous outreaches to get those people very interested, or to move that ball forward, if you will. One key tip is that you can just go back in your scent box 3-4 days later and just ping them again with a short message if you already did a long message. That is something that helps you hit those consistent outreach numbers, and also gives weight and value to the fact that maybe the person missed it. They probably didn't, but even you just showing to, hey, want to make sure you got this. Your goal is just to get an answer either way. If you can detach yourself from the outcome and realize that your goal is just to get an answer either way. And in fact, even if you get a no, you can always keep that relationship open for the future. In fact, that's what they always say, but it is true. So make sure to note all that information down. Then from there, we got into the pitch, we got into the pitch deck. And then what about next steps? So you had a good pitch. Your most likely thing is, wow, we're really excited about this, or we think this is great, or I think the pitch was awesome. Anything of that nature. Might even be light. It might be like okay, we thought this was good. We'd like to go talk about this. And how about we follow up with you next Thursday? If you get the date, that's what you really want. You want to get some sort of timeline for that next step follow-up. If you do that, you've gone ahead and you put yourself in the top 10% of call experiences and investors, because that's what you want. You want a clear, concise path for next steps, and be willing to ask for that, and keep it light and simple, and just move it forward. Send them the information, whatever they request. So that's the variation you're going to find. Is some investors, perhaps the person was a CFO, an operating CFO, and they're the general partner or a supporting partner of their firm, and they want to know about your scale model, or your business model and how it scales, or your current numbers, or your growth rate, or stuff like that. That is pretty common, that you're just going to have a specific thing that person's going to want to look for. Or if they didn't see something in your presentation in particular, maybe for an early stage company, they want to see more about your product, see a product demo, things like that. Your goal is just to say, all right, awesome, we'll go ahead and set that, and then we'll follow up next Thursday to see where you guys are at. Or best thing, again, if you could get a date for, hey, here's our next meeting. That's not always common unless the investor has a very specific process. Some do, some don't. I would say it's more on the some don't in that sense. So where we're getting at is your goal is to actually, again, follow up as quickly as possible. As soon as you get off that call, just go ahead, send the information. You're going to be really grateful that you did. Log it, and now you're moving forward. So from there, how does it work? Keep developing your funnel, running the process that we've talked about. Then your goal is to just get as many investors at this current stage. Your goal is to get as many investors as you can into that level, into that, all right, we're moving forward and we're taking next steps. When you've done that, you have really set yourself up for success, because it is a quality game. I've mentioned that in another video. It is a quality game. You want to be 100 times more specific when you are raising capital from investors than if you're just going out to sell your product. So for example, you might have 20,000 people, potential contacts in your market. Well, you're going to have 1/100th of that in your ideal investors batch that you're going to be really looking for. And think about the people first in that sense. And so 200 firms, there might be more people that you might want to go for. So at this point, your key is to follow up with whatever cadence that you've set. So this is the most pivotal part where I see people drop the ball, which is ridiculous to me, right? You literally have an investor who's like, I'm very interested. I'd like to talk to my partners to do this and this, and they don't follow up at the specific time, or they wait, or they delay. And that is a killer, because that is your nearest to the money. That's your 3 feet from gold. So if you said you're going to follow up on Thursday, follow up on Thursday and get it out there. You'll be very thankful that you did. Your goal, again, at this point, what's our next step? What's our next step? Are we taking a partner meeting? Do you want to see our data room? Are you passing? I just want an answer so that I can know where to note you. That's pretty much the energy that you're going to want to have. And of course, bring that excitement though as well. Hey, no one wanted to follow up at this stage. I really wanted to share something that is exciting that developed since our last call. We actually just closed another partnership with this huge company, and we think it's going to do this. And by the way, we got a lead investor. So are you guys okay with following? Now it changes the conversation versus, hey, by the way, are you still interested? Your response rate is going to be much higher. Of course, their conversation is going to have been their conversation, whatever they decided as a firm or are in midst of deciding. So with that, the key then is to know that the more traction you're going to be showing and developing, the better your outcomes are going to be. So now we've reached that step and you're in the home stretch. At this point, if you get another partner meeting, you may have, like, the most meetings you're probably going to take here is like 5 or so all the way through the end of the process. If we're just doing a pretty straightforward venture capital deal, you may do way more, but the process typically is a bit faster. So with that, if your next step is a partner meeting, do that partner meeting again. Have a specific deck for the partner meeting. If they say, hey, we're going to be coming in and we want to know more about your competitive advantages, then seriously take the time to make an additional deck that highlights that. So you might have one slide on that on your deck. Maybe you do a new deck that has 3. Maybe you just talk about that, but I would not recommend that because you don't want to overly focus on one thing. So for example, if they say, hey, we want to know more about your competitive advantages, well, that's super important, but think about it from a multitude of angles, not just like, here's comparison A, comparison B, your checkbox, your matrix of here's where we're at versus our competitors. Think about it from a variety of ways. Where are you better technically? Where are you better from your go-to-market, from your team? Those sort of things are going to matter. And you approach it more comprehensively. And then on top of that, what I'm saying is make sure that you don't make that only the focus. And they're like, hey, we love everything and we only want to know more about this so that we can move forward. Make that your focus, but be prepared just for other questions. Don't get caught off guard, overly focusing on one thing. If there's anything at this point that I found counterintuitive, is that if they say, hey, we're really going to focus on this, you overthink about that, because the last thing you want to do is get caught off guard with, oh, no, I didn't prepare that. I actually didn't think about that at all. At this stage, not the ideal place to be. You want to just be prepared. It's probably your deck, your primary deck. You add a couple slides to it. You bring a team member. So for example, if you're a strong go-to-market founder, and you have a strong technical co-founder, and then you have another person who your operations. At this stage, you're probably going to run into, the partner call is going to consist of the partner you spoke with, or the associate, or the principal, the general partner, and maybe someone else, and maybe more. So as you can see, there's a totally different dynamic than your typical first pitch call. So at this point, again, your mindset when you're going into these calls, though, is that you already got it. So you want to come off with this energy that you're very comfortable with where you're at, because that is going to also reflect on the words that you say, how you communicate, and it's going to give them that stronger confidence in your business and really in you and your team and how you all operate. So at this point, you're in due diligence. The partner call went well. You're in due diligence. It's really just about checking the boxes. In fact, you literally might get a sheet where they're going to say, hey, these are the 15 things we need to know, and we need you to document it here so that we have it. They're checking their boxes. You're checking your boxes, and they're making sure that their risks are appropriately assessed and noted and documented so that they can move forward confidently with an investment. And at this point, like I said, this is, in the end zone. This is the red zone here. Just be prepared for, whatever inquiries might come. Just make yourself very open for that. Say, hey, great, we passed this second stage partner meeting. Here's my phone number. Take my phone number down. If you guys have any questions, please feel free to call me. I'm available from this time to this time and more than happy to have a conversation. Or here's my calendar link if you have, somebody needs assistance from my legal team, or for the contracts and negotiations and term sheets, or from your financial team to talk about certain questions, or your technical team. Just make yourself available for that, and that will help you a lot. At this point, you get that term sheet. Then from there, you're pretty much locked in. You've got yourself a lead investor. Your goal is then, as you're still building that funnel, you've been building that funnel the whole time. Now you can go back to investor 3, 4, 5 who are interested and say, hey, we've got a term sheet. Here's where it's at. Let's move this forward. We want to close this round. So here's a key: set a close date. This thing is going to change your whole perspective. Setting a close date is by far one of the most effective things that you can do when it comes to closing your round. Set a close date, hold people to it. It'll show them, just like you're good to follow up with them on Thursday after that first call that we talked about. When you say, hey, we're closing by October 15th, so we're going to need all the commitments before that. On October 13th, 14th, actually, let's say the Monday of whatever, let's say the date's a Friday. Usually Friday's the best, right? Because then you actually giving people the whole week for them to for them to finalize whatever is necessary. And on that Monday, then what you're going to be looking at is, hey, Monday, guys, just a reminder, we're taking all commitments. We're very happy. Here's our calendar. We cleared the space for the week. We are so open to answer any questions so that we can get your commitments by the 15th of October. So if you set a tight close date, So for example, you're originating conversations and you're looking to close within 14 to 30 to even, let's say, 40 days, then if you're setting a tight close date, then what you, and without a lead investor, for example, you want to leave that door open to say, hey, if we're really just looking for that rock hard commitment, that firm commitment on this date. If you have other processes that need to wrap up before then, we're totally fine with that. That way you're getting the benefit of setting the firm close date, but you're also saying, hey, like I'm not going to throw you out the door if you're not entirely done with your diligence. I'm just going to make sure that you're committed by this date. That will change the game for you. And when, for example, if you have a lot of interest and you've kept that method consistent this whole part through, and you have a lot of interest, then there is going to be a sorting factor, because the ones that are really serious saying, hey, no, we're ready to go. And at this point, you take, let's say you're raising 10 million, you take your 10 and you may get a couple people that, hey, we're committed, we're just wrapping this up. And that's how you get oversubscribing, is that you've built up a large base. And I will say that doesn't typically happen over a short period of time. It's likely going to be that you've developed relationships over 2 months, 3 months, 6 months, even a year or more, whenever maybe it was from way back, from before you started this company. And that relationship is going to benefit what you're doing here. What I'm saying is that can help you oversubscribe. So if you've already been talking with someone for 6 months and you're coming in there and then you get your term sheet, and all of a sudden you have 14 people to go back out to who are, yes, I was just waiting for you to get a term sheet. That's how you oversubscribe. It's actually taking your time. That's what I would highly recommend. Is just, it's a very intricate balance. And so is most of capital raising. It's a very intricate balance. It's an edge, if you will. You're walking on the edge to do something compelling that is a great company, and you're willing to set a deadline, but then make sure that you're maximizing your outcome. You're maximizing your income, in this case, of capital flow, so that everybody can maximize their outcome. That's always how to frame what you're doing. Hey, we're looking to maximize, make sure that we're giving everybody the highest likelihood of success, because that's really the best you can do. So we talked earlier about this, like what are the assets that you have to leverage to accomplish this result? Your goal is just to have the highest likelihood, the highest probability of success in this venture, in this activity, or in this pitch call. It's just what can I do right now to give myself the highest probability of success? And so you've set your close date, you ask for commitments, you really align them with the vision. You say, hey, here's we're asking for your commitment today, sort of what I laid out already. You're going to get those commitments rolling in, and all of a sudden you just close your round. So as you can see, we just went through the entire capital raising process. We could talk about further from there. I'll just drop a note about it here. You could, and you may have already set up at this point, a investor newsletter or a cadence that you're saying, okay, we're going to update our investors every month or every 2 weeks, whatever that cadence is. And now what you've done is you've taken that one-to-one relationship and you've brought it one to many, and that becomes your continuous delivery channel by which you can say, hey, here's our 4 updates that are very exciting. That from this month, that's going to help you a lot. You want to take those investor relationships from one-to-one only to one-to-many plus one-to-one. So that one-to-many is going to save you tons of headache. The investors are going to feel up to date. They're going to be excited about it. You're going to continuously convey that excitement, which is going to help you with the next round. And from there, build your company. So we've taken you through this process. And in fact, my ideal recommendation in terms of your cost allocation for this, what you could realistically do for costs, is about $121 a month. That would be LinkedIn Sales Navigator. Highly recommend it. I've just found it to be very helpful when it comes to finding quality searches, quality investors. LinkedIn Sales Navigator is $99 a month. Pitch.com, that's where you make your pitch decks. That's my preference. Again, I'm not connected to any of these people. These are like the most inextricable tools that I found for this process. And then your Gmail address and your inbox aggregator, which is another 10, 15 bucks. You're sitting at $136 a month. And all of a sudden you can run this whole process I just laid out for next to nothing. So, and raise whatever money you want from venture capitalists if you have a really good company. So pretty exciting stuff right there. That is how you can create a great amount from something little, just a seed. So I hope you enjoyed this video, and I will see you in another one.